Guys, you are both have been bulls and have been proven right, been stubborn and right. Brian, anything that Mike just said or anything the markets have told us recently to see your enthusiasm eroded at the margin even?
Well, let me just add what Michael said. We've had 15 bull markets since the 1940s. The current bull market ranks 12th in terms of the compound annual growth rate. Bull markets don't die of old age, they die of fundamental reasons, and we think the fundamental construct of the United States stock market remains excessively stable, especially relative to the rest of the world. I think the number one problem with the market, Carl, is that we would go around the world and visit our clients and talk with them, is that clients once again have chased up the market because the Fed's cutting interest rates, or the perception, that the Fed's going to cut interest rates. We have now reared an entire generation of investors that only buy stocks because of bad news, meaning the Fed cuts in trying to stimulate growth, and we think that's the wrong strategy here. Our target for year-end is 3,000, but our upside target is 3,400. We still think the market closes higher from right now, but at current levels, given the perception and the worry about earnings, we think if and when the Fed cuts by 25 basis points, some of the momentum money is going to think that's not enough, and the market will sell off. We don't like making short-term calls on the market. However, we remain in our 20-year bull market camp when we made that call in 2009. So we think the longer-term bull market has a long ways to go. Interesting.
Krishna, DataTrek did some nice work at looking at aggregate consensus S&P targets and the way in which analysts really were not spooked by December. They stayed with their year-end 19 targets, but they're really not moving them up now. Why is that?
Well, so I think the reason they are not moving enough is because the expectation with respect to the economy still remains quite low. I agree with the previous speaker. I think we have 5 more years at least. His 20-year call is a really bold call, but I would go out on a limb and say 5 more years. And the growth outlook is going to improve in the second half. And I think on the back of that growth outlook, the consensus expectations are going to improve meaningfully. You have a perfect environment. You have moderating economic growth for sure, but far from being catastrophic. At the same time, you have really good policy support from a monetary policy standpoint for sure, but even on the trade front, despite all the things that you hear, we probably will get closer to a trade outcome that is positive as well. So I think the markets are setting up. My outlook is for 3,100. It probably goes higher rather than lower than that target.
I mean, I think it's definitely fair to observe that generally sentiment is subdued and people are not acting as if this has been some kind of celebration moment, the S&P getting to 3,000. That's probably a net benefit. But I also think that the reason for that is this has been going on so long, and we've been so in the habit of saying, is it almost over? Is it going to end? Why are bond yields so low? Well, they're also so low because we're worrying about if it's going to end. I don't think you ever kind of escape that cycle. So this could go 5 years, right, if Brian's right. But it doesn't necessarily mean that 5 years is going to be this carefree burst of, hey, everything is wonderful and we're going to celebrate all the time.
Well, it's kind of sound like a bunch of Eeyores. It's probably going to rain today.
As it is.
I think it never is carefree ever. So equities is really about taking risk, and we will have zigs and zags. But at the end of the day, everything is shaping up the right way, and things are going to look much better by year end.
Mike, you can you can look at all the sentiment indicators you want. What you really need to do is talk to clients and talk to investors. And this is the most hated bull market in history. We have a low degree of participation. I was in San Francisco yesterday, saw 3 big accounts. All 3 of them are sitting on their hands. They're nervous to invest. They've missed the big move so far this year. We've had net outflows in 2019, 18, and 17. You can't have a bear market if people are selling stocks. And we think all you have to fear is fear itself. And fundamentals in the U.S. in terms of looking everywhere else in the world, we believe that dollar-denominated assets are going to be a home for all assets for the next several years.
Krishna, tech was a really major leader from S&P 500, 2,000 to 3,000. NVIDIA up 738%, Amazon up 500%, Netflix up 455%. But with this growing tech lash, is tech really going to be the leader for us to that next leg higher for the S&P 500?
Well, I think for a while tech is going to be the leader. I think expecting the markets to do well with tech underperforming in a big way, at least on a sustained basis, I don't think that's how things are going to work out. At the end of the day, the tech companies are delivering growth in an environment where growth is really short. So people are going to pay really fancy valuations for those companies because, one, the growth outlook is good, and two, they're executing fabulously. Just look at Amazon.